defines a firm? You have OBHR person, right? For a OBHR person, the definition of a firm is very different. For, let's say, operation person, the definition of firm is very, very different. Just like that, for a finance person, the definition of firm is very different. Let's say for a marketing guy, the definition of his firm is very simple. There is a customer. He needs something. You have to identify what he needs, then produce that goods and services, sell it to him at an appropriate price. So this is how a marketing guy views a firm. For OBHR person, it is simple. Now you have an organization, you have got so many places, it has a hierarchy, it has communication channels. You need to place a suitable person in each of those places. Now that's how a OBHR person views an organization. Now operations guy, it is very simple. You need to produce this product. Now you have an assembly, you have a supply chain. Now how efficiently you are going to organize that production? How efficiently you're going to organize that production. That's how an operations guy view that firm. Now, how a finance guy views a firm? What is the financial, definition of a firm? Someone would like to, Rajesh? Go ahead, Rajesh.
Is it something, sir, is a business organization supposed to make a profit?
Everyone, even marketing guy would think about profit, right? No, I'm not talking about how we view a firm. No, I'm interested in, you have a firm. What is the definition of firm for a finance guy? That's what I'm interested in. Okay, Prakash Chand.
Sir, the investment decisions that the finance person is taking to make the profit in the firm to grow.
Yeah, that's only a part of that. It's only a part of the definition. Okay, good try though. Samyak. You're not there. You're not audible, Samyak.
Sir, can you hear me now?
No, I can hear it. Go ahead.
Yeah, just adding to what Prakash said, I believe it's something like an investment that a firm makes and the return that it expects out of the market. Maybe that's what defines from a financial perspective.
All right. Most of you are given the answer in bits and pieces. Now I'm going to combine all of them. Okay. Now, for a finance guy, the firm is very simple. Who is that?
Shadab.
Shadab, last chance. Go ahead.
Yes, it's basically a finance guy looks at a company as an entity where financial transactions takes place.
The marketing guy looks at the firm as an entity where marketing transaction takes place.
No, where needs of the customers are fulfilled.
Right. So you need to go beyond that financial transaction. You have to define that firm. Okay. Good try though. Okay. All right. Let's 76, 77 are online. Should I start or should I wait for 2 more minutes? So it's already 7:18. I should be get going. Okay. Now look at this one. This is how a financial guy views a firm. You have some capital. Now, capital could be either. What are the general forms of capital? Equity or debt, right? Equity or debt. Now, you need to invest this capital. When you invest, what do you create? You create assets, right? So that means using this capital, you are going to purchase assets. Now, these assets are going to produce cash flows, right? Now, assets are used to produce goods and services. Now, these assets are going to produce cash flows. Now, these cash flows are distributed among capital providers, right? So you have capital. This capital is used to create assets. Now, these assets are going to generate cash flows, and whatever the cash flows that these assets are generating, those cash flows are distributed among capital providers. Right? Now, whenever you take this decision, whatever the decision that you are taking, whether capital structuring decision means how much equity should be there in your capital or how much debt should be there in your capital. Whatever investment decisions that you are taking or whatever cash flow distribution decisions that you are taking, the guiding principle is firm value. Whatever the decision that he is going to take, it should result in increased firm value. Increased firm value. Simple. Now, these decisions, what these decisions are going to, so you have to create assets, right? Now, what kind of assets are you going to create? What kind of assets are going to create? Now, that's the decision that a financial manager has to make, right? He has to choose a prominent investment or the best investment among the number of investment that he might be having. Any idea what these decisions are called as? Any idea what these decisions are called as? Oh, come on, guys, you've already learned. Capital budgeting. Right. Capital budgeting decisions, right? They're also called as investment decisions. Now, these are the decisions which would result in the creation of assets. Now, how do you finance these investments? How do you finance these investments? That is called capital structuring decisions. Capital, STRUCTU. Whether you are going to invest this investment, whether you are going to finance this investment using only equity or debt or equity plus debt, it's up to you. Capital structuring decisions, or it is also called as financing decision. Okay. Now, what about this one? Now, these decisions, cash flow distribution decisions, are called as dividend decisions. Dividend decisions. Now, whatever the decisions that you are going to make, whether you are making capital structuring decisions or capital budgeting decisions or dividend decisions, now every decision is aimed at increasing firm value. It is aimed at increasing firm value. Simple. Now, these decisions you have already learned in FM1. FM1, how to make investment decisions. How to make investment decisions, that you have already learned in FM1. You have NPV, you have IRR, right? You have payback period, MIRR. All these things you have already learned. So, FM1 is all about capital budgeting decision. Now, FM2 is about this and this. About that and that. So in FM2, you are going to study capital structuring decisions and dividend decisions. Again, please remember that whenever we are making these decisions, our ultimate objective is to see that firm value is increased. At least firm value is not destroyed. Okay. Okay. One disclaimer. I am going to give you very crude or very raw slides. Whatever I teach, it is combined from so many textbooks. So I have made it very simple for you guys. You're not going to get these things in any of the slides or in any of the textbooks. So primary material for my quizzes and the end-term examination are my teaching. Okay, please make sure that you are going to take down notes. Okay, so I'm going to give you some slides only for reference purpose. Even for even the textbook that you are following, that is only for reference. Okay, you may not find all the material that I'm teaching because I'm in your reference book. So please pay close attention to what I teach during this session. All right. Now let's go back and check this one. Now look at this one. Now this is the balance sheet, right? Now what it represents? What it represents? Now look at these assets. Asset side. Now you have assets. Now whatever the assets that you have created, Manoj, you have a doubt or you wanted to answer? Manoj, you have a doubt or you wanted to answer something?
I wanted to answer it.
Okay, all right. Please. So if you have doubts, please raise your hand then and there itself. You don't have to wait till the end of the session, okay, to ask doubts. So whenever there is a doubt, please raise your hand. I'll ask you to speak. Then you can, get that clarified. Now, look at this asset side of the balance sheet. Which part or which decision is generating that resulting in asset side? Asset side of the balance sheet is a result of what kind of decisions that you are taking?
Capital budgeting.
Capital
budgeting.
budgeting
Budgeting.
decisions, right? Now, what kind of asset that is being there on your balance sheet is guided by what kind of capital budgeting that you have taken. So that means asset side of the balance sheet reflects your capital budgeting decisions. Now, what about the liability side? Now look at the liability side. What it reflects? What it reflects? It reflects simply capital structuring decision, debt and equity, right? How you are financing your assets. How you are financing your assets. Right? Now, these dividend decisions are also included in a part of capital. Where dividend decisions are included? Dividend decisions.
Cash
Where
flow
do you
statement.
find cash flow statement? It links. Remember, dividend decisions are included in other equity. Sorry. They are part of reserves and surpluses, retained earning. They're part of reserves and surpluses. That means the entire balance sheet of a company is nothing but the reflection of financial decision that you have taken. The past financial decision, okay? The entire balance sheet reflects what kind of financial decisions that a firm has taken. Right? Suppose if the Tata Motors has gone for acquisition of Jaguar, Land Rover, and all those things, right? This one, assume that this is a consolidated one. So this balance sheet reflects that decision. Now, if it had not gone for that acquisition, probably its asset side would have been entirely different. Even its liability side would have been different. Are you getting the point? So, whatever the financial decisions that you are studying, they put together, they would result in your balance sheet. Our balance sheet is simply the reflection of financial decisions that you have taken. Okay. Whereas profit and loss statement. Now, profit and loss statement. Now, what kind of decision it reflects? P&L. In P&L, you would get marketing and also operations, OBHR. Now, all of them are going to, form P&L account. Okay, all those decisions are reflected in P&L account. Whereas the entire balance sheet, it reflects the past financial decisions that you have taken. Now, any question till now? Any question? Sure. Yeah, go ahead, Rahul.
Professor, the last statement that you made about the P&L statement reflecting marketing OBHR, I'm not sure I completely captured that.
So where do you include your marketing decision? No, marketing decision results in some expenditure, right?
Yeah.
No, where do you include that? You don't include that in the balance sheet, right? So every year, marketing and administrative or marketing or selling decisions or selling expenditures are included in P&L account, right? So employee expenditure, training expenditure. Where do you represent it? Where do you put that? You're going to put it in P&L account, right? On that year's P&L account.
Okay.
So production decisions, all those things are reflected in your P&L account for that year. Okay. Okay. Any other question? So let's start our course. This is the perspective that it is in this perspective that you have to understand finance course. Now, whether you are going to take finance electives or not, that's a different story. But whenever you study finance, this entire picture should be there in your mind. Okay. Now we are discussing this one. Now this result is going to, whatever capital structuring result that we are discussing, that is going to be reflected in the liability side of the balance sheet. Okay, that's how you have to understand. And also you have to understand that whenever we are making any of these decisions, all of these decisions are guided by wealth maximization, shareholders wealth maximization. In general, we call it as firm value. So all these decisions. So whenever you are going to take up NPV project, positive NPV project, what do you mean by positive NPV? The firm value would be increased if the project NPV is 10. If the project's NPV is 10, means you are adding 10 rupees to the firm value. That is the additional value that you are adding through your capital budgeting decision. Okay, so just like that, you are going to make capital structuring decision. So what is the impact of capital structuring decision that you are making on firm value? That you need to understand. What is the impact of dividend decision that you are making on firm value? Now, that is the perspective in which you are going to understand this entire course. All right. Okay. Before actually understanding this capital structuring and financing decision, your financing decisions is rest on two important fundamental concepts. So, in fact, in finance, we have only two fundamental concepts. Now, what are those concepts? Two fundamental concepts in finance. Every decision that you are taking in finance are related to these two fundamental concepts. Any area? What are those fundamental concepts on which entire finance depends? Two fundamental concepts in finance. Sudarshan Sampath. Sudarshan, you are from Andhra Pradesh, I guess.
No, sir. Tamil Nadu.
Tamil Nadu, go ahead.
Is it golden rules of accounting, sir?
No. That is, accounting is different. No, we are not worried about accounting. Okay? Accounting is simply the recording of your transaction. Whatever transaction you are doing, how you are representing the transaction in the book. That is accounting. Now, finance starts from, once you have recorded, how you are going to use that recorded data. Finance results in that transaction, first of all. Finance results in the transaction. Okay? Yeah, Lamis, go ahead.
Is it profit and loss?
Profit and loss. One way it is related to this one, profit and loss. It is only one. Profit and loss. But there is much more to it. Okay, there is much more to it. You are right. Ilayya Raja, Tamil Nadu, right?
Native of Tamil Nadu, working at Andhra.
Good. Go ahead.
Money as time value.
Time value of money it's not a fundamental concept. Time value of money is not a concept. It's a technique. Okay, it's not a concept. One concept, fundamental concept is roughly you can say profit and loss. What is the other one? Manoj?
So, sources of funds and application of funds.
Right. See, sourcing and application of fund depends on two important things. What are see, whenever you are taking any decision for that matter. So all of you have invested in this MBA program, right? All of you have invested in this MBA program. Now, how did you invest or how did you decide to invest in this MBA program? Based on what? First is how much profit it's going to generate, right? That's for sure. How much profit it's going to generate. What is the second one? What is the second one? Okay, let me ask
Risk and return.
Uday. No, wait. Uday, go ahead. Not audible, Uday. You have to check your connection. Okay, Aditya.
Income generation and wealth generation.
Okay, all right. So somebody gave that, so I'll go. This is somebody said risk and return, right? Risk
Yeah,
and-
Uday was actually trying to say risk and return.
Okay, Uday was actually saying risk and return. Now, this is nothing but your return. Okay, this is nothing but your return. And the second important concept is risk. Or whatever decision that you take in finance, these two would govern such decisions. So every decision is influenced by risk and return considerations. So we need to understand risk and return. So before understanding financial decisions, first we need to understand risk and return. All right. Let's understand the risk and return concept. Now we will start with return first. After that, we'll go to risk. What is return? What is return to you guys? Lamis, where do you work, Lamis?
I'm working for HCL,
HL in what profile? In what
analyst,
Analyst, business analyst,
data.
data analyst. Okay, all right. You might be knowing what return is. Go ahead.
Return is, suppose we are making an investment, what is the loss or gain, anything associated with that?
Okay, and just give 100 rupees you are investing.
Yes.
Okay, go ahead. This is 0th year. Okay.
Yes, for a period of some certain
1 year,
years.
let's say. Okay.
Yeah.
Okay, give me how much you have to get. Let's say I'm getting 120.
Yes, then we can say it's a profitable. So
Oh, profitable. Okay, but I want to know what
positive
is my
return.
return.
Yeah, that is a
Positive return, but how much?
20%.
20%? Or entire 120 is your return?
So yeah, I'm sorry. Exactly what was the question?
What is return in this case? You have invested 100 rupees. You have got 120 rupees at the end of 1 year. What is your return?
The return is 20 rupees. So
20 rupees.
yes, extra. So that is a gain from the investment.
This word is important. Extra. Over and above what you had invested. The return is the gain over and above what you had invested. Gain means it could be negative gain also. Okay. So what you get over and above your investment is called return. Now, return, we have two conventions. Okay, we have two conventions. First convention, it is always expressed in terms of your initial value relative to your initial investment. So you had invested 100 rupees, you got 20 rupees extra. So relative to your investment, it is 20%. Okay, so return is always expressed relative to your investment in terms of percent. Simple. That's the first convention. What is the second convention? What is the second convention? Second
Relative to
convention
the
is
sales.
no, nothing. Per annum. Return is always per annum return. It is not per day return. It is not per month return. It is not 2 years return. It is not 5 years return. It is always per annum return. If you go to a bank says that 8%. 8% return per annum. That is per annum. Okay. Suppose you invest 100 rupees today, and you are going to get 150 after 3 years. What's your return? What's your return?
30 rupees per annum.
30 rupees? How did you get 30 rupees per annum?
16 rupees, 17 rupees per annum.
17 rupees per
Approx.
annum? Approx?
Hmm.
Okay, first thing, your absolute return is 50%. Okay, your absolute return is 50%. Now, this absolute return is for your entire holding period, which is 3 years. So this 50% is called holding period return. This is called holding period return. Now, holding period return is the return for the period, period of holding. For how long you hold that investment for the entire holding period. All right. It is not per annum return. It is not per annum return. It is for the 3 years in this case. This is called a holding period return. Now, if I want to express this in normal per annum return, now what is the per annum return in this case? Right, all of you have done time value of money, right? What is the per annum return in this case?
17%.
No, don't give me 17% like that. You have to calculate and you have to give me. Guys, if you are typing in the chat box, it is highly likely that I may not look into your chat, whatever you have typed during that period in time. Okay. And one more thing. Now, if you are writing something in the chat box, please mark it only to me, not to everyone. Okay. Only to me.
Approximately 15%, sir.
Approximately 15%. Okay. How did you get it? Nagendra, right?
Yes, sir. It's actually a compound interest kind of thing.
Right. How did you get it?
Through compound interest calculation.
Okay. All right. So you can easily use Arpan. Yeah, go ahead.
Yes, sir, it's actually 14%. I used the rate function RATE. Then the NPR is 3 years, and present value is
Right.
minus 100, and future value is 150. That is
Perfect.
14%. Yeah.
Perfect. Okay, that's how you are going to use. You can use rate in the Excel, or the concept is the same. So future value is given 150, present value is 100, 1 plus r raised to the power n. N is 3. So r is 150 divided by 100 raised to the power 1 by 3 minus 1. Right? You learned that in time value of money. So what is r? R is equal to 1.49. How much did you get? Arpan?
Yeah, sir. Actually, I have used the rate function. So
No, the rate function also works like this only. Don't worry.
14%.
The 14%.
14%.
oh, actually, you want to answer? Yeah,
14%.
14%.
14.7.
No, it's
Just 14.
14. Yeah.
14.5, sir.
So it's 14.47 exactly.
14.47 or 14.5. Okay.
Yes.
No, you cannot say 14.0. 14.47 or 14.5 is okay. Okay. Now that means on an average, every year you are getting 14.5% return. This is called holding period yield. That is called holding period yield. From holding period return, you can convert them into holding period return. This is per annum return. Okay. Now, holding period yield is also called as CAGR, compounded annual growth rate. Okay. In finance, we are interested in CAGR only. Now, whenever you want to express the return has to be compounded annual return. No, that's why per annum return. Why it is compounded annual? Because it is always considered we are going to express. That's a convention. We are going to express return on per annum basis. All right. Any question? So we discussed HPR and we discussed holding period yield. Right? Now, again, in finance, suppose if you want to invest in some company. All of you, let's assume that all of you are at 100 rupees. All of you are at 100 rupees. Now you want to invest in some company or some stock. Now, if you want to invest in stock, what would you do? Now you go to the market, right? You go to the stock market. Let's assume there are only two firms, A and B. A might be Tata Motors, B might be Infosys. Right? Now you have to decide where you want to invest. Now you want to invest in only one stock. Okay. Now, how do you decide? How do you decide where to invest in? Alvin, go ahead. Alvin, why don't you switch on your video?
Sir, first we will check the P by E ratio.
So that means you would go back and collect historical return, right? You are going to collect historical data. Okay, you are going to collect historical data. So, Pravesh Goyal, what do you collect? Let's say this is Tata Motors and this is INFI.
Sir, like you mentioned, the historical data and the data like P ratio, PB ratio runs.
So before that, you are going to collect for last 5 years. How much return has it given? Now you want to check that, right? How much return has it given over last 5 years? Let's say this has given 10%, minus 3%, 12%, 14%, 8%. These are the per annum return. Okay.
So basically, how much is the like increase in my stock price year by year, and also the dividend that I have received within those.
Right. So return is nothing but your capital appreciation plus dividend. Okay. Return is nothing but capital appreciation plus dividend divided by initial price P0. Okay. Now that's okay. Now these in 2023, Tata Motors had given 10% return. 2022 minus 3%. So you collected this sum. After collecting, what you are going to do? You are always interested in average return, right? You are always interested in average return. So over last 5 years, what is the average return given by Tata Motors? What is the average return given by Tata Motors? Do it. Average return.
IRR?
I don't know. You have to just give me average return over last 5 years. If you want to type, please mark it only to me.
46% over the last 5 years, Professor.
How much?
46%.
Not that. Per annum. I'm talking average return per annum. So Mukesh has given something. Mukesh Somlal. Roshan, go up to second decimal. Go up to second decimal, Roshan. Oh, you just have to add them up and divide it by number of observations, right? 10 minus 3 is 7.
Sir, 8.2.
Plus 12, 19. 19 plus how much? 33, 41. Right? 41 divided by 5, which is 8.2%. Right? Now this is the average. Now, is it the right return? Is it the right return that we are talking about? 8.2% on an average.
This
is it the correct one?
No, sir.
Oh, this is not the right one. This is arithmetic mean. It is arithmetic mean, and it is not equal to CAGR. It is not equal to CAGR. So how do I find CAGR from this data, for this data? What is the CAGR? What is my average return over last 5 years?
By considering the last 50-year data with the last year data, we'll be able to calculate the CAGR of that.
Give me the CAGR. How much is the CAGR? Narendra, I am really curious. Where is your camera? It is not in your.
Just a minute.
It is not there in your screen.
No,
Is
no,
it
it's
somewhere
not.
else?
We have a separate webcam.
Oh, okay, all right. So your screen is also visible. That's why I asked you. Yeah, go ahead. So calculate CAGR. So what we had calculated, 8.2 represents arithmetic mean. No, arithmetic mean is not the correct return. Okay, it is not the correct return. We need to calculate CAGR. To calculate CAGR, we use geometric mean. We use geometric mean. Now, how do we use geometric mean? GM is how much return did you get in the first year? You got 1 plus 0.1. That is the return. Next year on this 1 plus 1, you got minus 3. That means 1 minus 0.03. Third year on this amount, 1.1 plus 0.12. Fourth year, 1 plus 0.14. Fifth year, 1 plus 0.08. 1 by n minus 1. Now this is geometric mean, nth root of these values. Do it and give me the value.
8.02%.
8.02. Sumit, if you are completing very early, then type that in your chat box. Because other guys, once you give them answer, they are not going to try it. Okay? I want every one of you to try that. No, Anand and Medini, how did you get 7.67 and 7.43? Medini, you're there?
Yes, can you hear me?
Yeah, I can. How did you get the 7.67?
Sir, 1 by n, I took it as 1 by 1.5. I rounded it off to 1 by 5.
This 1 by n, whatever
Yeah.
the 1 by n. That is 1 by n
I
is
took
1.
it as 1 divided by 5.
Yeah, this is 1 divided by 5 only.
That's what I got, sir.
Oh, okay. This is nth root. Okay, 1 by n. Sorry, this is nth root. Simple, not 1 by. Fifth root of this one.
So CAGR, I got 1.4522 to the power of 1 by 5 minus 1.
What is the value?
1.4522.
1.4522 raised to the power 1 by 5 minus 1.
Yes.
How much is this?
I got 1.0767 minus 1.
1.0767
minus 1. Yeah.
minus 1. This is 7.67%. Now your friend has got 8.02. Now I am confused. Which one is right? Vijay.
Sir, I also got 8.02.
So it's possible I'm wrong.
No. Check your calculation once again. Okay. Check your calculation once again.
So I got 6.42. Yeah.
If you are getting different answers, I cannot help you. So, which is the common answer? I'll go with the common answer. Okay. Most of you are, this is the mode. So I'll go with 8.02. Okay. All right. You have to check your answer. Now, this is geometric mean, and this is equal to CAGR. On an average, you got 8.02% per annum. That is the return. Okay. Now, what is the relationship between arithmetic mean and geometric mean? Geometric mean is always lesser than arithmetic mean? No, sorry. Our arithmetic mean is always greater than geometric mean? Sure? No, it could be equal also. Arithmetic mean is always greater than or equal to geometric. When it would be equal to geometric mean? When arithmetic mean would be equal to geometric mean? Any idea? When do you think arithmetic mean would be equal to geometric mean?
When all the numbers are equal.
When all the numbers are equal, suppose every year you are making 10, 10, 10, 10, then your arithmetic mean would be equal to geometry. Okay. Otherwise, arithmetic mean is generally greater than geometry. Okay. Now, this is the return that you have calculated using historical data. Okay. This is the return that you have calculated using historical data. But whatever the historical return that you have got, it is no guarantee that you are going to get the same return next year. What we are interested in is, just a minute, guys. What we are interested in is the future return, right? Future return. So, historical return is no guarantee for the future return. So, we need to predict a return. We need to predict future return. Now, how do we predict? How do we predict future return? Any idea? How do we predict return? Any idea? See, the moment we say predict, yeah, Payal or someone, Goyal, sorry, I missed your name. Ramesh Goyal, go ahead. No, I'm not getting. Sumit, go ahead.
So based on the future cash flow prospects of the company and using techniques like
No, you don't have, you don't have any information about all those things. Using
can you hear me now?
historical return. Yeah, I can. Ramesh, I'll come back to you later.
Yeah.
Using historical return only, what is the general principle behind prediction? Any kind of prediction. What is the general principle behind any kind of prediction, not necessarily return prediction, any kind of prediction? The moment you say, I am going to predict something, there is one principle involved. Okay. Abhinav, go ahead.
I can only talk in terms of forecasting methods or
Right, forecasting.
Applying any statistical techniques to the historical
right,
data
applying
and
right. No,
like
what is
regression.
what is the basis for that applying in a statistical method?
Sir, then y is equal is like when y is equal
Okay.
to
You are
function
getting
of
into equation form. No. You are getting into equation form, but basic principle involved in that. Basic principle in regression or in any statistical method. Okay, Ashish.
Sir, we need to have historical data which we can trust on and
Right.
prune it and then use it in the models.
Right. Whenever you say model, what do you make use of it?
Sir, model is like, you have some data on which you first create an equation, which is what we call as
Right. Based on what?
on
What
the
is
historical data.
fundamental? Right. Okay, I'll come back to you. Om Pratap last.
Firstly, yes, utilizing historical figure and establishing relationship between variables, maybe.
Based on what? How do you establish that? Okay. Whenever you say prediction or whenever you say forecasting or whenever you use models, everything is built on probability.
Probability.
Everything is built on probability. When you say model, the model is also a probabilistic model. You don't go for mathematical model, right? It's always probabilistic model. So prediction, forecasting, modeling, everything revolves around probability. Now, we need to generate probabilities. Now, how do we generate probabilities? As most of you said, we'll go back to historical data. So let's say Tata Motors. I will go back to last 100 years data. last 100 years data. Okay. Now, last 100 years data, I have gone back and I am going to collect information. Okay. Let's say last year it gave 10%, last year -3, somewhere around 12, 14, 8, 6, 15. I collected. Okay. For timing, you can have 100 possible values, or some of the values would be repeating, right? Some of the values would be repeating. Now, for time being, I'm going to consider only these 8 values. These 8 values would keep on repeating. That's what I'm going to consider. Okay, only for the ease of understanding. Now, there could be n number of values. There could be n number of values, but I'll consider these values are repeating. Okay, all right. Now, in the last 100 years, now we are generating probabilities. Remember, we are generating probabilities. In last 100 years, in how many years you had 10% return? Let's say in 20 years. Out of 100 years, 10 years, 20 years, you had 10% return. In how many years you had -3% return? You had -3% return in 10 years. In how many years you had 12% return? Let's say 25. In how many years you had 14% return? Again 25 years. Okay. Yes. Okay. In last 8% in how many years? How many years? In how many years you had 8%? Assuming that only these values are repeating.
20%. 20%.
20. It should be equal to 1, right? 25 plus 25, 50, 20, 70, 80. So in 20 years. Right? So I have generated, these are the probabilities, right? So if I purchase Tata Motors, what is the probability? I purchase this Tata Motors and hold it for next 1 year. Okay. What is the probability that I'm going to get 10% return? There is 20% probability that I'm going to get 10% return. If I hold Tata Motors for 1 year, there is 20% probability that I am going to get 10% return. There is 10% probability that I am going to get 3% return. There is 25% probability that I am going to get 12% return. And there is another 25% probability that I am going to get 14% return, and 20% probability based on 8% return. Yes, Vijay.
Sir, can't we say that 20, this 10, 12, 14 together, at least I'll get 10% for the probability of 70%?
You can cumulative probability, right?
Yes, sir.
You can say like that. So I have 70% probability that, how much you said? I'll get at least 10%, right?
Yes, sir.
20 plus 25 plus 25.
Yeah.
Possible. Yeah, right. You can say that. But I'm not interested in that. What I'm interested in that is I want to have CAGR. What is the expected return, per annum return, if I invest in this one? Expected per annum return. Okay. So you have generated probabilities associated with possible return, right? These are the possible return, and these are the probabilities associated with those possible return. So from this, I'm going to calculate expected return. Expected return is nothing but this into this plus this into this. What is this much? 10% into 20% into 10%. This is 2 minus 3 into 10%. How much is this? You have to multiply and give me the answer. Do for all these things and then add them up.
9.8%.
So 9.8?
Yes.
All of you are getting 9.8%?
Yes, sir.
Are you getting 9.8, all of you?
Yes, sir.
Perfect. Adel Bedamo. Done?
Sorry.
No, not sorry. My daughter was making some noise. I just told her not to make noise. That's it. So 9.8. Simple. So the expected return for Tata Motors is 9.8%. Okay. Now the question is, if I hold this Tata Motors for 1 year, how much return would I get? How much return would I get if I hold Tata Motors for 1 year?
Nine point eight. Expected value is 9.8. So we are
Okay,
expecting to get a 9.8.
Fatima,
Average
right?
value.
Yes, sir.
Fatima, where are you from?
Mumbai.
So what's your background?
Sir, I'm an operations manager working for Intel.
Good. Fatima says that if I hold that security for 1 year, I'm going to get 9.8%, right? Expected to get 9.8. Now, how many of you agree with Fatima? Fatima, am I getting it right?
Yes, sir.
Okay. How many of you agree with Fatima? Abhinav. Oh, you have got so many followers, Fatima. Oh, no, only 2, only 3. So, rest of the class, they don't agree with you. Now, let me ask why some of your classmates don't agree with your answer. Anand Parambat.
That is
Where
just
are you from, Anand?
Kerala itself, sir. Calicut.
Oh, you said that, right?
No, sir. That was Rajesh.
Okay.
I'm from the same center.
Okay, good. Calicut. And why you don't agree with your friend?
Sir, actually, that is just an expected value. You cannot be sure about it.
So what's the use of this value then?
It's just an expected value, sir. You cannot be sure. It can be even, there is a 25%
No, my
chance.
question is simple. If I hold Tata Motors security for 1 year, how much I am expected to get? No, she said, Fatima said 9.8%. You don't agree with her. Then what's your answer?
9.8 can be expected value, sir, but it is not exact value.
Okay, all right. You are making a point, but still I need Avinash. Go ahead. Again, you are from Kerala, Avinash Menon?
Yes, sir. Based in
Okay, go
Bombay.
ahead.
Sir, just I may be wrong, but wouldn't the expected value change based on the time frame? So, for example, if you say expected value for 2 years,
No,
it will
Avinash,
be
Avinash, don't bring in so many other things. My problem is simple. I am holding Tata Motors for 1 year. How much return am I going to get next year? That's the question.
It would be EFR of 1 year, which is 2. I'm not sure, but
just 1 year. Okay, all right. Abhinav.
Sir, I'm in the support of the motion.
All right. Okay, Ilayaraja, do you have any other answer?
Yes, sir. It can be based on past data anywhere between -3 to 14%.
Exactly, that's the answer. Now, if you hold this Tata Motors for 1 year, there is 20% probability that your return could be 10%. There is 10% probability that your return could be -3. There is 25% probability that your return is going to be 14. Another 25% probability that your return is going to be 12 or 14. 20% probability that your return is going to be 80. So your return would be one of these values. Your return could be one of these values. It's not going to be 9.8. Then what is the use of this 9.8? Why do we calculate expected return? Now, how do we define this 9.8? Now, if you hold this Tata Motor for 1 year, the possible outcomes are only 5. And these are the probabilities associated with that. Then what is the use of this expected return?
No,
Why
this
did you
is
calculate 9.8? Okay, Ashish, Mota.
The chance of it 9.8% is more.
No, there is no 9.8% in these. These are the possible outcomes. 10 minus 3, 12, 14, 8 are the possible outcomes. Guys, please
So
mute.
9.8 is the rate.
Rate, yes, it is the rate. That means return. How do we interpret this value? What is the use of this 9.8% return? Okay, all right, Sumit.
So if we hold it for the long term, then maybe we can expect better.
That is the answer. That is the answer. Answer is that now this 9.8, you have got it from 100 years data. That means if you hold this security for long term, the average return, remember, this is the average return. Average per annum return would be closer to 9.8%. On any given year, your return is going to be one of these 5 values. On any given year, your return is going to be any one of these 5 values. But if you hold the security, then in the longer run, your average return is going to be 9.8. Average per annum return is going to be 9.8. This is the long run expected average return, per annum average return. Understood? Any question? Any question? Yeah, go ahead.
Sir, long term in the sense how much? What is that?
No, this is based on 100 years data, right? This is based on 9.8. We have got it used based on 100 years data, right? Yes or no?
Yes, sir. Yes, it is
Okay, sir.
400 years.
So, right. But in general, now, if you hold this security for, let's say, 15 to 20 years, your average return move towards 9.8. Okay? Average return move towards 9.8. All right. Any other question? Okay. All right. We have, we do have, Shadab.
Sir, if we hold it for 5 years, then also it would be 9.8%.
No, it won't. You see, the interpretation of this value is that if you hold this security for long term, no one has defined it. Since I got this 9.8 using 100 years data, I am generalizing it to 100 years. Now, if you are getting the same probability distribution using, let's say, 15 years data, are you getting the point? So then you can say that on an average, if you hold this security for 15 years, this would be the expected return.
But sir, we are repeating this data, no? 5 years data. We are assuming that it is getting repeated for another 20 cycles.
Right. That's what we are assuming. That's the assumption, you know. Without assumption, you cannot build models. Okay. Sanketa, go ahead.
So, but practically, like the rate of return for 100 years would not be the same, right? In practical scenario, we are assuming
May not be the same. Yes.
So
Right.
it will be like it can be rounded up to decimals, and many multiple return would be
True. It depends on what kind of data have you used and what is the window of your calculation.
So what is the
In this
ideal sample size that we have to take
Nothing.
in such a case?
There is nothing called ideal sample size anywhere in this world. Now, if you say sample, ideal sample size, then everyone is going to use the same sample size and everyone is going to come up with the same answer. Then there are so many institutions which say that my forecasting is better, right? So there is nothing called ideal thing in this world, especially in prediction. If you have ideal prediction, then you are gone. We wouldn't be, speaking about finance at all. So there is nothing called perfect model. Now this is the principle. Now this is the principle that you are going to use in all financial models. Now it's up to you how much data you want to consider, how much length of the data, whether you want to consider daily data or annual data. It's up to you. That part is an art. Okay, that part is an ask. Okay, any other question? All right, what we'll do is we'll take 15 minutes break and then we'll reassemble at 8:30. Yeah, Bipin, go ahead.
So one question. So, can you hear me?
Yeah, please go ahead.
Yeah. Okay. So in a real world, there won't be like, 3 occurrences of 10% or like, 5 occurrences of 3%, etc. Right? In that case, are we going to take the geometric mean, and is that going to be our expected?
No. You are going to still use the probability only. In that case, you are going to have 100 observations. That's it. If the observations are not repeating, then you are going to consider all 100 observations with 1% weight, right? What 1% probability. Then if you take the simple average, that would be your expected return.
Okay.
Simple?
Yeah.
Okay. All right. Let's take break for 15 minutes and then we'll reassemble, okay? Okay, we'll reassemble at 8:30.
It can cause loss in the capital.
Right. The probability of losing the capital. So threat means that only, right? No, you don't know whether it's going to happen or not. So there is a probability. There is a probability of some sort of threat, right? Yes. Lamesh?
Something in any unpredictable event that cause the losing of
Unpredictable. Unpredictable. No, you have used one interesting term. What do you mean by unpredictable?
we cannot assess that. We cannot we cannot assess or predict that will be happening, but it is not in our
So
control.
So you have predictable and unpredictable, right? I'll come back to that point a little later. Okay. Rajesham, Om, you have already done. You can lower your hand. Yeah, Rajesh. Go ahead.
Measure of uncertainty, sir.
Measure of uncertainty. Interesting. Measure of uncertainty. Certainty. Okay, interesting. Ilayaraja.
Not getting any desired income. The deviation from the desired output.
Good. Deviation from the desired outcome, right?
Yes.
All right. Now, the last one. Sonam, go ahead.
The uncertainty on the return of investment.
Okay, uncertainty. Okay, that someone has already given. Nian?
Sir, that is by the influenced by the various factors like
No,
credit
let's
issue.
not worry about the source of risk. But what is risk? First, let us understand risk. Then we'll understand the sources of risk. Okay, all right.
Okay,
So
sir.
we are using some terms called unpredictable, uncertainty, and risk synonymously, right? Right? That's what we are using. Now, let us understand these whether these words are synonymous or not. Now, do you think unpredictable, uncertainty both are same? Okay, these are synonymous. Unpredictable means uncertain. Now, do you think this uncertainty and risk are the same? No, they are not the same. Okay, they are not the same. Now, look at this one. Whatever we did in the previous slide. No, there is an event. Event is your investment. You are trying to invest, and when you are trying to invest, you know what are the probable outcomes, right? Now, these are the outcomes. You know all the possible outcomes. There are 5 possible outcomes in this case, right? And also, you know the probability attached to each of those outcomes, right? So that means in this phenomenon, you know all possible outcomes and the probability attached to each of these outcomes. Now, this is called risk. This is called risk. This phenomenon is called risk. Okay, this phenomenon. Still, we are not defined risk. We are talking about the property of risk. In risk, you know possible outcomes and you know probability attached to each of those outcomes. But if you don't know all possible outcomes, then it is uncertain. In risk, you know all probable outcomes and the probability attached to each of those outcomes. Whereas in uncertainty, you simply do not know all probable outcomes. Since you don't know all probable outcomes, you cannot have probability distribution. Right? Now here, you have distributed probability across these outcomes, across these possible 5 outcomes. Right? Whereas in uncertainty, you simply cannot know what are the probable outcomes. All possible outcomes you don't know. Now, since you don't know all possible outcomes, the distribution of probability across outcomes is also not possible. If you encounter that event, that is called uncertain event. In finance, we don't deal with uncertain event. Risk and uncertainty are technically different. Remember, risk and uncertainty are technically different. Risk is a phenomenon where all possible outcomes along with their probability is known. Whereas in uncertainty, all possible outcomes you do not know. Okay? In finance, we don't deal with uncertainty. We deal only with risk. That means we deal only with this kind of phenomenon. What is risk in this case? You simply don't know which one is going to happen tomorrow. You know all possible outcomes, but you do not know which outcome you are going to realize tomorrow. And that is the risk. Okay, so now we know what is risk and what is uncertainty. So this are not there. Okay. Now, how do we define risk? How do we define this? Suppose you are going to invest 100 rupees. There are three possibilities. Next year you may get 90. Next year you may get 105. Next year you may get 1. This is 20%, 30%, 50%. And suppose I'm just giving you this additional information. You are borrowing this 100 rupees from a bank which is going to charge, let's say, 8%. You have the cost of this capital or the expected return, okay, not expected return, required rate of return. You know required rate of return, right? Required rate of return on this capital is 100 rupees. Now, if you are investing in this, if you are investing this 100 rupees in a project A, it has three possibilities. 20%, you are going to end up with 90. 30%, you are going to end up with 105. And another 50%, you are going to end up with 150. So these are the three possible outcomes. And the probability associated with each of those outcomes. So this phenomenon is risky, right? Now, technically, how do we define risky? Which one of those three possible outcomes is risk for you?
First two outcomes are risky, sir.
First two are risky. That's what Ilayaraja says. Okay, all right. Nidhini, go ahead. Nidhini, you are not clearly visible actually. Only your, top of your head is visible. Why don't you lower your camera?
Yeah. Yes.
Perfect. Go ahead.
So risk is only 90 because if my expected return is 100, then only the possibility that I will end up getting less than that will be risk.
Okay. So according to you, if you are getting lesser than what you had invested, that is risk for you. Perfect. Good. So anyone who would support Medini? Medini, unfortunately, none of your friends. Oh, okay. At least few of them are there. Okay, Avinash. You support Medini?
Yes, sir.
Okay, good. Om? Good. So there are so many guys. Nishant, Nikhil, Om Pratap, Avinash. Oh my God, list is very big. Okay, now, anyone who do not want to support Medini? Oh, everyone is supporting Medini.
Sir, I think I'd like to add
Oh,
one.
wait a minute. Anyone who is not supporting Medini? Only those guys have to rise.
Yes, sir. So I think.
Okay. Wait. I'll ask you, Bibin. No, there is someone. Narayana, go ahead. You are not supporting Medini.
Yeah, because we have planned 8% as our return from this investment. And if it is less than that, then it is risk to us.
Okay. So for Narayana, it is 50%, right? 90 as well as 105 is risk.
Yes.
Right? Now that is what he has said, right? That is what he has said. Deviation from the desired outcome. Your desired outcome is 108. The probability of getting less than 108 is risk for you, right?
Yes.
Okay. All right. Risk in general, this is the case. The probability of getting less than what you wanted to get. Probability of getting less than what you wanted to get is risk. Okay, risk for you. You are not worried about, this aspect. If you are not simply worried about this aspect, but you are worried about this one. This is what you want to manage. Now, if you come with this one, then you are happy actually. Right? Then you are happy. So here, the probability of getting less than 8% is 50%. That is the probability. That is risk. Right? There is 50% probability that I may get less than 108. There's 50% probability that is the risk that you are carrying. Right? Now, this is only half of the concept. Okay? If risk is less than getting what you expected to get, that is definitely you are worried about that aspect only. But the other aspect of risk is that the probability of getting more than 8%, the probability of getting more than 8%, that should also be high. That should, suppose if there is a, now you know that risk and return are positively related, right? Risk and return are positively related. We will discuss this. Why they are positively related, we will discuss that again. Okay, risk and return are positively related. So that means higher the risk, high risk means higher should be the return. Right? High risk means high should be the return. That means to say that when the probability of getting less than what you expected to get is more, there is also a very high probability of getting higher return than what you expected to get. Okay, the risk is too so. Okay, I'll come back to this one. There you are going to understand it much better. Okay, but in general, risk is defined in terms of probability of getting less than what you expected to get. Okay, in general, that is what you are worried about. That is what you are worried about. Okay, now the next question is, how do you measure this risk? How do you measure the risk? Now remember, whatever the measure that you are going to measure should give you this probability of getting less than what you wanted to get. So how do you measure this risk? Suppose you have 100 rupees, and your required rate of return is 8%. Okay, you are thinking about to this one. Now, the A security, the minimum return, minimum and maximum. Minimum and maximum. -5 to 25. This is 5 to 15. Which one is more risky? Your required rate of return is 8%. Risk is always defined with respect to your required rate of return. Okay. Which one do you think is more risky?
A.
A? Sure. So there is greater probability, right? Because the values can range from -5 to 25. Which one of them you are going to get, you don't know simply. In this case, at least you know that you are going to get either 5, 6, 7, 8, something that the range is very small. Possible values are very small in this case, because in this case, possible values are very dispersed. Possible values are dispersed. So which one you are going to get, you don't know. You may end up getting -5, or you may end up getting 25. You don't know. All right? So first is range. Okay, first one is range. Range will give you how much dispersed your values are. Okay, how much dispersed your values are. So greater the dispersion, greater the dispersion, greater is the risk. Okay, greater the dispersion, greater is the risk. But look at this one. This range, though it gives you a crude estimation of risk, does it give you probability? What is the probability of getting less than 8%? Does it give you that information? It simply says that, these are the possible, maximum and minimum values. Your return is going to lie between these two. But it doesn't talk about probability of getting less than what you wanted to get. So, though range is a crude measure of risk, it is not a perfect measure because it won't help you to quantify the probability of getting less than what you wanted to get. So, which one am I going to use? So you know how risk is being measured, right? And many of you are into modeling, right? Many of you are into modeling. Analyst, models, you know. So simple. So first thing is, whatever the measure that you are going to tell me, that measure should measure the dispersion of possible values, and also at the same time it should help you to calculate probability associated with each of these values. Now what is that measure? You know it, guys. You have already used it. You are afraid to tell that.
The standard deviation.
Okay. Okay. Who said that? Standard deviation? Who said that?
Me, Abhinav.
Abhinav, first raise your hand. Okay. No, not like that physically.
I'm so sorry. I thought you were talking to me.
Not like that. Okay. Okay. Pulkit, Abhinav said standard deviation. Do you agree
Yes,
with
sir.
him?
Yes, sir. Standard deviation, the scenario analysis is also a method. We use
Oh,
the
let's not talk about no. Let's just talk about standard deviation. Okay.
Okay.
Okay. You have Sumit. Sumit, you don't agree
Sir.
with standard deviation, right?
So maybe coefficient of variation can be a better measure.
Which one?
Coefficient of variation.
Coefficient of variation is also derived from standard deviation only, right? First, you have to calculate standard deviation and mean. Only then you will go to coefficient of variation, right?
Right.
Okay. Now, the standard deviation. So where is Pulkit? Do you think the standard deviation can be converted into probability? I said that the measure of risk should give you the probability of getting less than what you wanted to get.
So from probability, the standard deviation will draw the normal distribution curve and all this. Sir.
Perfect, perfect. Now, how do we do this? How do we convert this standard deviation into probability? That's the question, right? The answer is, suppose my required rate of return is 8%. Okay. So you are going to calculate z value. Z value is x bar minus mu divided by SD, right? My x bar is 8% minus, let's say 12% is the mean. Standard deviation is 6. 8 minus 12 is minus 4 divided by 6. How much is that? Minus 0.67, right? Now, you can, this is z value. Z value is minus 0.67. You can easily calculate the probability associated with this minus 0.67, right? You can easily use a norm-dist. Norm-dist in Excel. Use norm-dist in Excel, you will get probability distribution associated with minus 0.67. So that means if your required rate of return is 8%, if the sample mean is 12% and standard deviation is 6%, then using this information, you can easily calculate the probability associated with less than 8%. Right? So that means I can very well use standard deviation to measure a risk. Okay? Now, by definition, remember one thing, by definition, standard deviation is something which is, oh, sorry. Now look at this one. Now, which one is more risky? Yeah, Fatima, I'll come to you. Now look at this one. Now this has smaller standard deviation, right? The upper one has smaller standard deviation. That means possible values are low. Whereas the bottom one, look at that dispersion, right? Now, when I say the probability of getting, this is minus 25, okay? This is minus 25, lower one. At the same time, you also have probability of getting 30% return in the lower one. So that means ST says that if the probability of getting lower return is high, you would also have probability of getting higher return high. And that is risk. Okay, risk is not one-sided. It is not always probability of getting lower return is high. Now, if you have probability of getting lower return high, at the same time, the probability of getting higher return would also be high. Now that is risk. Okay. Now look at in the upper one, you don't have any values beyond 15%, right? You don't have any values beyond 15%. And also you don't have any values lower than -15. So, yeah, Fatima, go ahead.
Sir, is there a reason we assumed a normal distribution in this case?
Some distribution, okay? Now, there are many researchers who do not agree with this normal distribution, okay? Because usually returns have fat tails. So that means extreme values are also very common in return. Whereas in general, you do not have, right? In general, normal distribution do not consider fat tails. Okay. Now, which distribution do you use doesn't matter. You are going to use some distribution. Are you getting the point? Since this is a fundamental core course, we'll end up using only normal distribution just to make things clearer to you. But when you go for advanced modeling, there you are going to use different distribution. You are not going to restrict yourself to normal distribution. You would also use different distribution, which would account for fat tails. Okay. No, we'll stop the discussion here because this is a core course. I am just trying to introduce the concept. Okay.
Thank you, sir.
Okay. Any other question? Okay. And I am not going to deal with how to calculate standard deviation and all those things. Since you already know, I'm not going to deal with it. Okay. Any question? Any question on risk? So we know what risk is. We know the difference between risk and uncertainty, and we know how to measure the risk. Simple. Now, let's go back to our previous example. This one. Okay. Now look at this one. 0, 1, 2. These are the years. Okay, you are investing 100 rupees. Now, next year, how much you are going to get? Let's say one of these 5 values. One of these 5 values you are going to get next year. Let's say 12%. Now, you have 12%. This 12% return could have been 10%. It could have been 3%, -3%. It could have been 14, or it could have been 18. But you ended up with 12. Next year, you may get, let's say, -3%. Next year, you may get 14%. Now remember, when you get 3%, there were 5 possible values. Here also 5 possible values, right? Every year, you are getting one value out of those possible values. The risk is not across years, what values you are going to get. Risk is standard deviation of this distribution. The risk is standard deviation of this distribution. Simple? Now, since every year the values are getting repeated from this distribution only, the values are getting repeated from this distribution only, right? And hence, even when you consider, let's say 4, 5, 8%, no, then you have got 10%. So when you calculate the standard deviation across years, that standard deviation would be equal to this standard deviation, because all these values are derived from the same distribution. Are you getting the point? The risk is this. Which value are you going to get on a particular year? You don't know, right? Which value are you going to get on a particular year? You don't know. The standard deviation of this is the risk. Now, in reality, every year you are going to get one value. So you are going to calculate standard deviation from historical return, right? So when you calculate the standard deviation of historical return, you are assuming that all those realized return are from the same distribution. That's why when you calculate the standard deviation across years, that would be equal to standard deviation of this one. Yes, Fatima, go ahead.
Sir, I think you answered my question, but basically, how do we have, similar to return, how do we have an averaged value of risk?
No, you are not going to calculate the average value of risk. You simply
So
going to
always-
calculate the standard deviation across years. Suppose
For each year. So for this 100-year
each year,
scenario,
no,
I have-
each year you cannot calculate, right? Because each year what you have is only one value. Are you getting the point? Okay, let me. Suppose Tata Motors, last 5 years, 10%, 12%, -3, 14, 8, 6, something like this. These are the realized values. This is 2001, 2002, 2003, 4, 5, let's say 6. These are the realized values. This is what you have got. Now, in 2001, you got 10%. The 10% is what you have got. It could have been any other value. It could have been 12%. It could have been -3. It could have been 14. It could have been 8. It could have been 6. Right? No, in the second year also, it could have been any other values. What you are doing is, you're assuming that these values, whatever values that you have got here, these values are the possible values in any given year. And hence, when you calculate the standard deviation across years, that standard deviation would be equal to this standard deviation.
The same.
That's your assumption. Yes. Now, that's why when you calculate standard deviation of this series, now that would be equal to standard deviation of this. Did you get that, Fatima?
Yes, sir. Got it. Thank you.
Okay. Any other doubts? If you have doubt, please let me know. So Fatima, where did you say you are working?
Sir, I work for Intel.
Intel, no, what's your job profile?
Operations manager.
Okay, operations manager. All right. Any other question? Now, let me hear it. Say, you have individuals, right? Each individuals are different, right? So each individual are different with respect to their risk aptitude. Risk aptitude. Now, based on risk aptitude, we can classify individuals into 3 categories. One is risk neutral, risk averse, and risk taking or risk loving. Risk taking or risk loving. Now, who are these individuals?
So what is the middle one?
Risk averse, AVERSE, averse. I don't know who these individuals are. Can someone help me? Okay, only one. Who are these risk neutral individuals? I don't know. Let me. Go ahead.
Sorry, I can try going ahead with the risk averse. Risk averse means
No. Okay, go ahead.
Risk averse means when there is a risk involved, for example, an investment, then the expected return also will be higher. Increasing with the risk, the expected return also will be higher.
Okay. No, in order to understand that, first we need to understand who are risk neutral and who are risk taking. Then only we can understand risk averse. Okay. Aditya, go ahead. First time.
Risk neutral or risk averse? Risk averse is basically.
Let's start from risk neutral.
Okay. So it doesn't depend upon the quantum of risk is not something which they take into consideration. They're neutral to the amount of risk, whether it is high or low. The risk averse is someone who is disinclined.
Wait. So there are two expected return and risk standard deviation. Okay, expected return 10, 10, standard deviation is 5, 10. Okay, how many of you would invest in B? How many of you would like to invest in B? Okay, Ashish, go ahead. You would like to invest in B?
Yes.
Yes?
Yes.
Yes or no?
Yes. Yes.
Okay. Okay, all right. Narayan, okay, sorry. Nishant, you'd like to invest in B or A? Nishant.
Sir, it's Niyant actually. I
Oh,
thought
sorry,
you
sorry.
was.
Niyant. Yeah, go ahead.
Yes, sir, in B,
Oh, why? I'm
risk
curious.
taking,
Why you are investing in B?
because expected return is high.
No, in both the cases, expected return is 10, 10
10.
only.
Yes.
So then why are you investing in B, which has got greater risk?
Yeah.
All right. Abhinav.
The A.
A. Okay. Now, before understanding this, we need to understand what is rationality in finance. Okay. In finance. Now, we assume that investors are rational in finance. Okay. Now, what do you mean by rational? What do you mean by rational?
Logical, practical.
Logical, practical, good.
Yeah.
Now, what do you mean by logical?
So going with the current situation and not
That is not logical.
Taking calculated decisions
Calculated
and
decision.
yeah.
Interesting. What do you mean by calculated decision?
So understanding, I mean, what could be the risk and what could not be the risk, going by the past data. So analyzing certain stuff and then taking the rational decision. So which could be the logical in that way.
So rationality has Bibin. Do you have?
Yeah, can you hear me?
You have to switch on. You have to switch on your video, Bibin.
Yeah, so the laptop video is a problem, so I've
You are there in the center, right?
Yeah, I'm in the center, but the laptop has a problem.
Okay, next time you better switch on your video, okay?
Right.
Okay.
So
go
a
ahead.
rational person means that he'll always prefer profit more than loss. So he's gonna look for profits, is what we
Okay,
can
all
say.
right. So rationality has two important considerations. First, what is your objective of decision making? Your objective is always to increase your utility. Utility could be profit, it could be anything. Okay. Now, the objective of any rational person is that he is a utility maximizer. So whatever decision that he is going to take, that decision is aimed at maximizing his utility. Okay. The second thing, he is going to make the decision using the available information. Available information. Now, available information may not be the complete information. Whatever the information that he has got, based on that information, he is going to make utility maximizing decision. Now, this person is called as rational person. Some of you called him as logical and all those things. Basically, it derives from he is going to use information to make his decision. Okay. Now, what is the objective of his decision making? To maximize his utility. Both are important. Remember, utility maximization and available information. Both are important. Now, those guys are called as rational guys. Now, that means in finance, we deal only with rational guys. We do not deal with irrational guys. Okay. If in this case, now utility has two things. Now, you want to maximize positive utility, and at the same time, you want to minimize negative utility. Okay. Utility has two things. Positive utility, maximize it. Negative utility, minimize it. Right? If someone wants to go with B, that means they are not rational. Okay? They are not rational. Now, risk neutral. Simply define this word neutral. Simply define that word neutral. What is that neutral means? They are neutral towards risk. That means they don't consider risk in their decision making. For them, both A and B are the same. They're indifferent towards risk. In their decision making, they consider only the return aspect. They don't consider risk at all. They're neutral towards risk. They're indifferent towards risk. If any such individual exists, such individual is called risk neutral. Now, how many of you are risk neutral? Now, how many of you do not consider the risk in your calculation, in your decision making? Is there anybody who do not consider risk in their decision making? No, every one of you, right? So that means none of you are risk neutral.
So
None of you.
sometimes we have to. Sometimes we have to. Uh,
Give me an example. Interesting, Lamesh. Give me an example.
Okay. Maybe the course we are doing right now, the academic purpose. So I can't say it is there is risk involved, but there are some kind of trade-off we have to do. Maybe the
No, trade-off. Right. You're right. You have to do trade-off. But you did consider risk when you're making decision making, right?
there was a time involved or the kind of amount of time and effort we have to give, and maybe we weren't able to do that also. So
No, that
considering
is okay. No, Lamesh, that is okay. See, you are not considering full amount of information regarding the risk of this, program. But that's okay. But when you are making decision with available information, you would have considered riskiness.
yes.
That's enough. Now,
Yes.
that's why I said with available information. You may not be having full information. Whatever the information that you had, you considered both risk as well as return. If you had considered risk, whatever the risk, however small that analysis is, then you are not risk neutral. Okay? Okay, all right, Mukesh.
So in risk neutral, while doing the asset allocation, we can invest in FD or something that can be the.
No. In finance, don't consider the existing of risk neutral individuals. For finance, even if there is an individual who is risk neutral, all our models do not apply to such individuals. Whatever we discuss, they do not apply to risk neutral individuals. So at least in finance, they are only theoretical constructs. Yeah, Niyant.
Sir, the person who buys a lottery ticket may be a risk neutral because he don't know the consequences.
Why do you think he's a neutral, risk neutral? No, first let us understand all three, then you can ask me this question. Okay? No. Who is this risk-taking guy? Who is this risk-taking guy? Yeah, all right. Aditya, go ahead.
Irrespective of the amount of risk the person investing on the basis of the return that they are making.
A return is risk neutral, irrespective of risk that you have said, right? If he is making his decision based on the return, then he is risk neutral. No, risk taking. Now we are discussing risk taking.
Okay, I will rephrase. So the quantum of risk is not a decision making factor for that. So, for example, Niyant
No, that is
mentioned
in
about
risk
lottery.
neutral. That is risk neutral. Quantum of risk is not a factor in your decision making. Is risk neutral. That means you are indifferent towards risk. You don't consider risk at all.
Yeah, I'm okay. The ability to take more risk.
The ability to take more risk is not risk. This one. Okay, any new hand? Amazing, go ahead. Sumit was there. Okay, all right, Sumit, I'll come to you.
Someone who is willing to take more risk, expecting a higher return, will be risk taking.
No, and the moment you say expecting higher return, gone case. Sumit, go ahead.
So if in any security there is a probability of getting a higher return as well as a lower return, and if the individual is ready to take, to invest in that security, then he is ready to take the risk. So he's risk taking guy.
All right. Is there any individual who would like to go with B? No, I have changed it. Expected return 5, standard deviation 30. Is there any individual who would like to go with B? Now, if you are risk-taking individual, you would go with B. Now, their primary consideration is risk. They want to have that thrill. The perfect example, I would say that, Vijay Mallya. Not everyone can be Vijay Mallya, right? Now, there, the primary objective is to have more risk. Even if the expected return is lesser, that's okay. Okay. In case of risk neutral, primary consideration is the return. Okay. In case of risk taking, primary consideration is risk. Now, even if you are getting lower return, doesn't matter. The thrill of having higher risk, now that makes them to go for that opportunity. Now, those guys are called risk taking. Those guys are called risk taking. Simple. Again, just like risk neutral individuals, finance do not consider individuals who are risk taking, the existence of the individuals who are risk taking. So they are not there, they are there. Okay. Now, apart from risk covers, there is one more category that I have not told you, but I will tell you right now. Okay. I'll give you one example. Now, how many of you follow cricket? Anyone who doesn't follow cricket? Anyone who doesn't follow cricket? Oh, there are many of you. Okay, and Neelanjan Sinha. Neelanjan, where are you from? Oh, you're not audible, Neelanjan.
Better now?
Oh, now better. Go ahead.
So I'm from Mumbai.
Mumbai.
Yes, sir.
And being from Mumbai, you do not follow cricket.
Unfortunately, I don't like that sport.
Oh, you don't like? That's okay.
So hence I don't.
In order to not to like, you must follow it first. Only then you won't like it, right?
Right, but yes, I used to follow it. Like after the 2011 World Cup, I have not followed it.
Oh, because of MS Dhoni?
No, nothing like that. There was no.
Why did you stop watching cricket after 2011?
Just lost interest.
Okay, all right, Niranjan. But you still follow. You know the games, right? You know how it is being played. Okay. Now I want someone who doesn't know anything about cricket. Anyone? No, since all of you. Okay, Medini, you do not know anything about cricket? No, you have to unmute.
Not really, no, sir.
Okay, you are a good candidate then. Okay. Let me ask you one question. So, which is the strongest T20 team in the world?
I don't know. Patriotically, I will say India, but I have no clue.
Okay, let's go with India. Since they are the world champions, let's go with India. Okay, which one is the weakest one?
No idea.
You have to come up with some answer.
Pakistan, maybe.
Okay, what's this Pakistan? Okay, who is giving you this answer? Who is giving you? The one who is...
Somebody in the center.
Oh, who is that guy?
Rahul.
Rahul, okay. Okay, ask him, if India plays Pakistan today, what would be the winning percentage? Winning probability for India?
No idea.
No idea, Rahul? Oh, come
But
on.
percentage, I don't know.
No probability. Yeah, go ahead. Give me some probability. If India plays
65, 35, 65 in favor of India.
Oh, then Pakistan is not the weakest one, right? Then Pakistan is not the weakest one.
No, the answer I gave Medini was patriotically Pakistan. Patriotically, the weakest team is Pakistan.
No, she didn't tell that one. Okay, according to you, Rahul, which one is the weakest one? Not patriotically, logically.
Perhaps Ireland or
Okay,
Ireland at this point in time. Yeah.
Okay. India plays Ireland today. So what is the winning probability? 99?
95%, yeah.
99% or no 1%. So Rahul, are you into cricket betting?
I'm not into any sort of betting.
Oh, come on. Life itself is a bet. No, you cannot say that you are not into any type. Are you married?
I'm not married, no.
Oh, so then you are going to take a big bet on that. Don't worry. Once you get married. Okay, all right. Suppose you are into betting, let's say. Okay, India is playing Ireland today, and the property is this one. Okay. Now you have to bet for Ireland winning. Okay, and the reward ratio is 1:1. Now, if you bet 1 rupee for Ireland, if Ireland wins, you are going to get 1 rupee. Now, if this is the reward ratio, would you go for betting for Ireland?
No chance.
No chance. Okay, no chance. How many of you would bet for Ireland if the reward ratio is 1:1? Anyone? Okay, let me increase it to 1:5. You know no chance? Okay, let me increase it to 1:1 lakh. Oh, now I can see so many hands. See, I didn't change anything. The same two countries, the same probability of winning and losing. What I did, I just changed the reward ratio. Just by changing your reward ratio, I am making you guys to take more risk. Right? Earlier you were considering not to invest in this one because you were thinking that that is high risk event. Right? You were considering that as a high risk
This
event
150 you
because
make
there is 99%
200
probability that India is going
and
to
this
win that.
550 you make
By changing the
450
reward ratio, what did I do? I changed your behavior.
and
Now,
find
now
out
you want to take that risk.
optimal
Are
alpha
you getting
value
point?
that can reduce your
Now, what
MAP
kind of
and
individuals are
RLC.
you?
Sir, which three values did you change?
What kind of individuals are you?
Risk taking.
Risk
taking?
adverse.
Risk averse.
Risk adverse.
All of, not adverse, averse. Now, all of you are risk averse. Risk averse doesn't mean that you don't want to take more risk. It simply means that risk, I can make any individual to take more risk provided if there is enough reward. If there is enough reward. So that means these are the individuals who always take investment decisions or always take decisions considering the trade-off between risk and return. The trade-off between risk and return. Now, look at this one. For someone, 1:1,000 could be enough. For someone, 1:1,000 could be enough. For someone, 1:5,000 could be enough. For someone, they have to go up to this level. That means each one of you are different with respect to that sensitivity, risk averseness sensitivity. But all of you are risk averse. Now, we were talking about positive relationship between risk and return, right? Positive relationship between risk and return. Now, what is the source of this positive relationship? Why do we assume risk and return are positively related? In finance, we always assume, right? Higher the risk, higher should be the return. Why? Because we are risk averse. Because we are risk averse. Individuals are risk averse. So that means to say that whatever we teach in finance, whatever the models or concepts that we teach in finance, they invariably assume that investors are risk averse. They invariably assume that investors are risk averse. Simple. So two assumptions. Investors are rational and investors are risk averse. Now, risk averse doesn't mean that they don't want to take risk. Risk averse doesn't mean that they don't want to take risk. It simply means that in order to take higher risk, you need to provide sufficient return. Any question till now? Any question on risk averseness? Any question on risk neutrality, risk taking? Yeah, Bibin, go ahead.
So one question here. So there is one person, like, there is some people who are gonna take that 1:1 ratio. Some persons who's gonna take that 1:5 ratio. So like, what is that return to risk ratio where you sort of say that, okay, this is a risk averse?
No, that's what I said. That is highly individual in nature. For someone, 1:1000 could be good enough. For someone, 1:100 could be good. For someone, they need 1:5000. The coefficient would vary. The sensitivity would change.
Yeah. So what I'm saying is that it's very difficult to sort of consider who is risk averse versus who's risk taking.
No, everyone is risk averse.
Okay.
Everyone is risk averse, but the kind of return that you have to give in order to make them to take risk, that would be different.
That is true. So in a way, we could say there's no risk taking person at all, right?
No, there is no risk taking person at all. At least in finance, we don't consider their existence.
Yeah.
Okay.
Yeah.
In finance, we don't consider their existence. We don't consider the existence of even risk neutral individuals. Now, even if they are there in the society, we don't care about them. Our models and concepts are built based on the assumption that individuals are risk averse.
True. Yeah, but even in society, there's nobody who's gonna be risk taking by that definition.
There are some individuals, I guess. See, they have the thrill. See, they don't want to earn money. Okay, they don't want to earn money, but they want to have the thrill of achieving something which is very difficult. And I have seen at least some individuals who the probability of winning is 1% only. Okay, if you win, you are going to get ₹1 only, very less amount of return.
Right.
But still, they want to go and they want to achieve that. Now, because there are some individuals, okay, risk-taking individuals I have seen, but finance concepts are not applicable to them.
Got it. Okay.
All right, Rajesh.
Sir, just more clarification on risk neutrality. So you mentioned the term indifferent. So whether it means it's indifferent to a constant return or the option which they are getting.
No, Rajesh, whenever you are making decision, what factors do you consider? Do you consider only return, or do you consider only risk, or do you consider both risk and return?
Both, sir.
No, then you are risk averse. If you are risk neutral individual, you will consider only return. You don't consider risk at all.
Okay, that I got, sir. But the return, whether my question is for an example, suppose if I am having an option of getting 100 rupees for 100% probability, and
no, you don't consider that probability at all. That's what I'm telling you.
Okay. Neutrality, no consideration on that. Okay.
You don't consider risk at all. That means, what is the probability of not getting 100 rupees? You don't consider. You simply consider how much I am going to get.
Okay.
All right. Any other question? Okay. All right. Now, we said that individuals are. So you are not going to get any of these things in your textbook. Be careful. I am telling you. You are not going to get any of these things in your textbook, whatever the textbook that you are going to follow. So by the way, please follow Gitman et al. The textbook which was there for FM1. Okay, don't follow the new one. Okay, now we said that individuals are risk averse and they are rational. Okay, let's assume that. Now, when I say rational or risk averse, you always have to keep in your maximization principle. Maximization principle is to maximize return per unit of risk or minimize risk per unit of return. Both are the same. Okay, both are the same. Now, this is your utility function. Okay. Okay, all right. We said that risk and return are positively related, right? Risk and return are positively related. Now, what is the relationship between them? What kind of relationship is it? Is it linear relationship or non-linear? If it is non-linear, what kind of? Yeah, Abhinav, go ahead.
Sir, linear.
Abhinav say linear. Okay. Other guys? No. When I say risk and return, what? Suppose. No, simple. This is the risk, okay? These are the risks. 1 unit, 2 unit, 3 unit, 4 unit. Now, if I have to push you from 1 unit to 2 unit, how much extra return I should give you? Okay, someone, I need a volunteer. Any volunteer? I need a volunteer who has not spoken yet. There are so many silent guys in this batch. Now, why you guys, so many of you are silent? Alvin Blackstone. Alvin, you are there?
Yes, I'm there, sir.
Okay, Alvin. Suppose if I have to if I have to push you from 1 unit to 2 unit risk, how much extra return I have to give you?
How much extra return?
No, just come up with some.
Extra additionally 10%.
Okay, 10%. So, in order to move from 1 unit to 2 unit, suppose he was getting 10%, now he has to get 20%. Only then he will go for this option B. Okay, this is A, this is B. Now, I want to push him to option C, where the total risk is 3 units. How much extra return I should give you, Alvin?
30%. No, not 30, maybe 40%.
Extra return, I'm talking about extra.
Extra return. Yeah. So I want it to be at least 40%.
40%. So that means 60% return I have to give. From
D will be maybe 100%.
100%. That means how much? 120?
Yeah.
And look at this. What is happening? What kind of relationship is this? Is it linear relationship? So that means for each additional unit of risk, I have to pay him more and more, right? First unit, just 10% was good enough. Second unit, I had to pay him 40. Third, 100%. So that means in order to make him to take more and more risk, I have to pay him more and more. Right? Now, what is the relationship? Is it linear or non-linear?
It's non-linear.
Non-linear. So, in general, risk and return, they follow non-linear. In non-linear, what kind of relationship?
Exponential.
Okay, exponential or quadratic, right? Now, this is the accepted form of relationship. Okay, you don't have to worry too much about this one. Since some of you were interested in modeling, I just gave them. Okay, now we understood that thing. Now let's go back and discuss this one. So let's assume that all of you have got 100 rupees. No, all of you have got 100 rupees. 100 rupees. Rupees 100, not 100%. So you want to invest. You go to the market, A and B. You go to the market. Okay. Expected return 10%, 15%. So which one are you going to invest in? Which one are you going to invest in?
B.
B. So
B.
given the information, you are going to invest in B. So now I am giving you additional information. Standard deviation.
A.
B.
A.
A.
B. A.
A.
A. Okay. Let's assume. So it is based on the assumption that return per unit of risk. Okay. Let's assume that this is 2 units. This is how much? 1 point. Come on, guys.
1.5.
Right? Now, all of you go with this one. Now, suppose if you invest in A, if something goes wrong with A, what will happen to your investment? There's a probability that, something may go wrong with A. If something goes wrong with A, what will happen to your entire investment? Suppose there's a probability that A may go bankrupt, right? If A goes bankrupt, what will happen to your 100 rupees? You are going to lose the entire 100 rupees, right? However small the probability is, that's okay. But still, there is a probability that you may lose entire 100 rupees if you invest only in A. The same case is with B. If you invest only in B, there's a probability that you are going to lose the entire amount. There's a probability. However small that is, that's a different story. Yes or no?
Yes.
Yes, sir.
So Nasrullah?
Yes, sir.
Yes or no?
Yes, yes.
What is yes?
Sir, this
What yes?
if it is not getting, then whole money will be wiped out.
Really? Who is helping you? Who is sitting besides you?
Sir,
No?
sir, person is there.
No, some person. I want to know the name of that person.
No, from 15th batch, ND is there. Narvada sir.
Come on, Nasrullah. I know that you are not listening to me. You are speaking to your friend. When I ask that question, your friend helped you out, right?
Sorry, sir. That is last.
No, that's okay. See, I don't have anything to do with that. See, if you miss one simple point, probably you're not going to get the entire concept. Okay? And I can show you my email from section D and E. Now they were supposed to submit assignment today. I have received around 50 emails today. Deadline. Sir, we have not understood the assignment. 50 emails, I can show you. On the deadline day, 50 students have said that they have not understood what assignment I had given them. Okay, be careful. And
Yes.
okay, all right. So, how do you avoid such situations? If you invest only in one of them, then there is a probability that you are going to lose the entire amount. You're going to lose the entire amount. So naturally, all of us are concerned about that probability, right? Naturally, all of us are concerned about that probability. So, how to avoid that probability of losing our entire amount? How to avoid that probability? How to avoid that chance? Split it.
Distribute that.
Right, exactly. That means you are not going to invest only in A. You are going to split your investment across or between A and B, right? Probably 50% in A, 50% in B. The weight is up to you. How much you want to invest in A, how much you want to invest in B, it's up to you. But you are going to split your investment between A and B, right? Now, what is the assumption behind the splitting? What is it? This is very, very important. Okay, understanding this assumption is very, very important. Okay, Sumit, go ahead. What is the assumption behind that splitting?
The assumption is that both the companies will not go bankrupt at the same time.
Of right. The assumption is that the event which is making firm A bankrupt, the event, remember, the event which is making firm A bankrupt is specific to that firm only. The same event is not going to be seen in firm B, right? So whatever the event which is happening in A is specific to A only. And whatever the events, negative events which are happening to B, they are specific to B only. They are not seen in A. Are you getting the point? Only then, and the probability of both of them are going to jump bankrupt together is very, very small. Probability of both of them are going to bankrupt together is very, very small. So that means to say that you can cancel or you can reduce whatever negative thing which is happening in A by some positive thing happening in B. And that's how you are reducing your A. No, that's how you are reducing your overall risk exposure. You are thinking that the negative things which are happening in A are specific to A only, and you can recover some part of this negative with the positive things which are happening in B. So that means the return of A and B should be negatively correlated. That's how you are going to choose A and B, right? Now, this is very, very important to be understood. The things which are happening in A are specific to A only. The things which are happening to B are specific to B only. Usually, the negative things happening in one security are neutralized or offset by some positive things happening in other security. Okay? Now, that is the concept behind minimizing your risk. Minimizing your risk. So, what did we do? Earlier, we had, I'll come back to you, Narayan. Earlier, if you had invested in firm A, the entire risk was there with A only, right? What did you do? Now you have distributed your risk or you have diversified your risk from A to across A and B by investing some amount in B. Now this process is called diversification. This process is called diversification. Now, you need to understand this very carefully. What are you diversifying? What are you diversifying? You are diversifying the risk. Earlier, your entire risk was concentrated with A. Now, your entire risk is concentrated between A and B. Now, you have split the risk between A and B. So diversification, the basic objective of diversification is, what is the basic objective? Why did we go for splitting? What was our objective?
Mitigating risks.
No, our basic objective is to minimize the risk.
Reduce the risk.
So minimize.
Reduce risk.
That's the same.
Right? Nowhere we are speaking about return. Did we speak about return till now? So that means in diversification, your primary importance is to manage your risk or to minimize your risk. Of course, you are going to sacrifice some return. You are going to sacrifice some return. But the reduction in return is much lesser compared to the degree of reduction in risk. Now, once you have split up your investment between A and B, what do you get? You get portfolio. Okay, you get a portfolio. Yes, Sumit, go ahead.
So I have a question here. Why do we consider A and B as negatively correlated? I mean, they can be not.
If something is negative happening, you would expect that something positive should happen in B, so that whatever you are losing here, you are going to get that. Okay, even if it is negatively related, that's okay. You may be losing 10 rupees here, you may lose 1 rupee here. That's okay. But if it is positive, this is negative, then the reduction is much greater, right?
No, what I'm trying to say is that they can be positively correlated in a milder way. I mean, not.
Yeah, right. I agree with your point. But you can achieve maximum reduction if they are negatively correlated. Okay. So